Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
Here we are in mid-March, ready for another weekly market recap. As for real life issues, this week was particularly stressing because we are having a bit of issues with the bad weather. And in my region, in the area where I do live here, we are seeing a few rivers. A few of them are just tiny and minor, but the main river of the region is actually in the process of outflowing out of the embankments. So there is a massive red alert for the weather and potential flood risks. So yeah, I mean, a bit nervous, a bit on the edge. Not for me personally, because I do live up the hill, but for instance, my parents, they do live actually close enough to one of these rivers. So kind of leaving by my phone right now, just in case my father calls in. Not sure what I could do even if he calls in. It's not like I can't stop the water, but guess it's always better to know rather than not. So, beside my personal issues, let's jump into the market and let's start out as usual with the economic calendar. So, we have seen starting out with Monday, we got data out of Germany, and again, not particularly cool. As for the exports and the balance of trades, industrial production ticked up a bit, but I mean, it's just one data point. It wouldn't put too much weight on it for now. What else? Let's try to just be focused on the main ones, I guess. So let's jump into the US. Why not? So we got on Tuesday the job openings, which came in a bit higher than the previous read and higher than the consensus. So you might think, well, then it's cool. Well, it's not cool, not really, because if you check a long-term trend for this data point, it just looks like it's slowly bleeding out. It's not really collapsing, at least not yet, hopefully, but it's not an uptrend. So still, I would take it as the labor market is a little bit under pressure here, and I quite honestly, I don't expect it to improve nowhere near soon. Okay. And then we got the big event as usual of the week. Even if I gotta admit, this week it wasn't that big of a deal as it might have been in the past. But we got CPI, which came in kind of in line with expectations, right? Uh, well, didn't see any particular surprise here. The month-over-month read came in at 20 basis points positive. The consensus was 30. But compared to the January read, which was 50 basis points, a bit down, right? Or a bit lower, should I say. The core came in at 20 basis points positive for the month. And overall, the year of the year read, as you can see, it came in at 2.8, down from the previous read of 3.0, even, so 3%. And the consensus was 2.9. So not a huge deviation here. What you might notice, although I'm not sure I got a chart for it, I'll check it out later and then eventually I might hit it. But uh, one of the components of the index remains particularly stubborn, and I'm talking about shelter, which grew, I guess, 0.3% last month. It's still a bit lower than the previous read in January, which was 0.4, but you know, it looks like it's a bit shaky. Overall, if you check, for instance, you can try to check the Zillow rental index, and you will see that the BLS it's still reporting data which are, I guess, well above the this real-time data for rent. So I keep on thinking inflation it's slowly decelerating. So still disinflation. It's just that once you get, the initial spike in inflation and then it cools down real fast, it gets to a point where it looks like it can't really go anywhere. It looks like it's just still It's not moving. You got just these tiny fluctuations here and there. But I think overall, it's gonna come down and a bit more than this. All right. What else? The Bank of Canada again. We've seen a rate cut, and that was highly expected to be fair. So again, not a huge surprise here. Um, Before I forget, and we move on, speaking still about inflation, and the data which are oftentimes a bit misleading and you don't know how to take them. When you check inflation expectations and you kind of decompose the survey as for the political belonging or affiliation, should I say, you see that again, we are looking at one of the same phenomenon we've seen in the past. I guess that last time it was as for jobs, maybe, or for the economy itself. But still, standing to the University of Michigan survey, it looks like Democrats are thinking inflation is gonna skyrocket. Uh, and Republicans, of course, they think inflation is not going to be a problem. And then, of course, you have I never understood what they are referring to when they say independent, but I guess we should take him as the less biased type of a group. And again, they are still thinking about inflation going a bit higher than this. So another interesting discrepancy there. So let's move on. The day after, which was what? Wednesday, I guess. No, Thursday. We got the usual jobless claims, the 4 week average, which came in kind of in line. No, no huge deviation there as well. So still should be on an uptrend trajectory, although, it's not really steep, but it's going up nonetheless. And of course, we got PPI. So again, PPI came in particularly negative, which you might say, well, that is cool, right? It means inflation is going to be lower. Um, Maybe, I mean, if you were focused only of these data point, maybe the point is that yeah, they both came in below expectations, right? And I guess this is just the second negative print as for PPI that we've seen since April 2020. So I let you imagine the importance of this read on the negative side. But when you look again at the subcomponents, you see that a lot of them, which are then factor in the calculation for PCE, they are still particularly negative in the sense that they are still a bit higher than what you would want to see in order for inflation to tick down and therefore the Fed stop being hawkish and maybe keep on cutting rates because inflation is not longer a problem. So uh, there are a lot of data points in this period which are just in contrast one with the other. So it's not easy to depict the right picture, no pun intended, for the macro situation right now, or for the US economy in this case. Other than that, we then closed down the week on Friday with inflation in Germany, which came in line with expectations. So no surprises there. Um, GDP for the UK was particularly bad. Once again, the UK it's not in good shape. So yeah, I mean year over year it just went down by 50 basis points. It's not cool. Even in industrial production, compared to the previous rate, which was half of a percent positive, what it came in at almost minus 1%. Okay, I'm not really following the UK so closely, so or I would give it the benefit of the doubt in case of seasonal adjustments, base effect, and whatnot. It's not really something I'm really focused on. What I was interested in was, again, for the US, the Michigan consumer sentiment. It came in very negative compared to the forecast and the previous read. And I think if you dig into the report, what was even more ominous, I might say, is that the expectations for unemployment throughout this year, so 2025, they just collapsed. So, which is why I said about the jolts, yeah, a good read. Maybe it's good, but maybe it isn't. Uh, because expectations are not particularly cool for people which were interviewed. Now, we're talking expectations, so it might happen, it might not happen that the labor market actually gets fucked, but even expectations can be important because then they are reflected in behaviors, consumer behavior, and therefore spending, and therefore aggregate demand, and so on and so forth. So it's the usual self-fulfilling prophecy, right? If you think things will go badly, you will start to act as things will need to be bad in the future. If you act as things will be bad in the future, you're going to be the catalyst for things to actually turn out to be bad in the future. So interesting dynamic as usual when it comes down to market psychology. But enough of this, let's jump into some charts. And since we have talked inflation, CPI, and whatnot, let's start out this time around with yields. So despite a benign type of read, as for the CPI and PPI, yields actually climbed up this week with no major pullback, even after the data release. If you just look at the price action itself, this is nothing unusual. We were discussing 2 weeks ago there was a good potential for a bounce here. Markets don't move in a straight line, and all the same slogans, right? The good old cliches. But I mean, it's not like they spiked, right? It just looks like a normal pullback. And I think after up until the point we are stuck in this range right here, which I mean, I might draw it here, but you could really extend it out up until this point right here, and these lower boundary here. And I'm just taking this one on the left, but I mean, realistically, you could apply the same on the others, right? So off up until the point we are in this range, nothing really changes around. If you want to check the others, you might say this should be your range low. And at this point, this area right here should be your range high. And for the 2 year, at this point, we were already in a range. We break down from it. So you might say, you know what, at this point, we might establish a new trading range for these yields from this area right here up to, I don't know, maybe this, or yeah, kind of like it, right? So I wouldn't change my read on it up until we actually get out of these boundaries right here. Now, as for the bonds, of course, as you might expect, they didn't have a really good week. They didn't collapse again. I guess the TLT is down what? Not a lot, really. Opened up the week in here, so it's down what? 0.6%. So really not a lot. They just consolidated again because I mean we've seen bonds moving around these way many different times. They got these violent spikes and then they just consolidate for a while before the next move. So nothing particularly relevant in bonds for now. Um, you might want to check what happened with the Fed Watch tool since we are going to have FOMC next Wednesday. So it looks like the market for now it's pricing in no cuts at this FOMC meeting. Um, maybe for May. How about May? if I can actually access it. It looks like the page. Oh, okay. Oh, well, 71% no cuts. What is strange is that if you look at 1 month ago, these read right here for no cuts, it was 81%. Then 1 week ago, it dropped down to 63%. And now it's back up to 71, 72% almost. Yeah, again, very volatile. I think the market it's just trying to price in something which is impossible to price in because I mean it's hard to price in stuff right now, considering that Trump could always come up one morning and saying this or that and completely destroying the outlook and forecast that the market are putting in. Um, let's move on to currencies. So as for the BRICS, nothing new. They keep on trying to climb to the upside. If you check the Chinese yuan and the ruble, again, I guess the ruble is benefiting a lot from this type of calm, which is getting back to to be in place in between Russia and the United States with all these talks about peace in Ukraine, diplomatic relationships being re-established. So it might be the ruble it's catching a bit just because of that. But if you check the others, I mean, the Brazilian real it's still particularly grim, and the Indian rupee is even worse than that. At least they stopped. They are trying. They are really trying to stop the dump at this point. The downtrend. We'll see what's going to happen with these. Not a lot for now. As for the majors, let's call them these. As for the euro, the pound, the yen, they didn't move a lot this week. The only thing I might notice is that I was expecting a bit of a pullback both in the euro and the pound. Doesn't look like it. Well, that doesn't mean it's not gonna come from here till the end of the month. I was just thinking maybe an immediate reaction was due. Uh, no, it doesn't. Still, I think the DXY it's trying to hold a good level here, and of course we got a very much open leg above it. So, uh, you know, would be so hard to put together a bounce here, and conversely, a pullback in the euro, the pound. I don't think so, but again, currencies they tend to be like this, kind of like yields and bonds. They move quite slowly, but and then they got these 3, 4, 5 days of rush, and then they get back into a consolidation for another month, maybe. So, quite honestly, this is what you expect from a currency, since the main goal of every central bank is to guarantee the stability in between one currency and the other to maintain stability in international trade, right? We'll see what's going to happen. The Canadian dollar is still particularly weak again, so might be tensions in between the US and Canada because of tariffs, because of the border. But this thing right here, it looks unable to catch a bait, quite honestly. Um, the yen still climbing up. Again, I'm not seeing any particular risk for a blowout in the carry trade. Um, so for now, that should be contained. And this is just normal market behavior, I guess. So nothing unusual. If there is something I wanted to point out on currencies, that now everyone is talking about one of the greatest negative week for the DXY, and therefore they think the DXY is actually representative of the dollar as a whole, right? As against all other currencies. Well, you might be surprised to know that it's not really. And all it takes, it's just a random search on the internet to find out that the Fed actually came out with something like this in green. Okay, let's see if we can bring that up a bit better. There you go. This is the trade weighted US dollar index. And what does it mean? Well, it basically means that, in a nutshell, uh, the DXY is a very old type of index. It gets back to the times where the majority of international trades conducted in US dollars were actually established in between the US and Europe. Now, of course, things changed around with globalization and whatnot. So even the trading partners of the US actually changed. So you got China, you got South America, Southeast Asia, and at a point, and I guess it was, don't actually remember the date, but the Fed just thought that coming up with a new type of index to better weight all the different currency which were a component of it would have been such a great idea. I actually agree with that. I mean, it's kind of pointless, right? To keep on looking at something like the DXY, where almost half of it's uh, represented by the euro, when let's say the majority of your trades these days are actually happening with China. So they came up with this new tool, and yeah, I mean, I guess when you look at it, you do actually see that although you might think the dollar is going down against its peers, well, maybe not. It's clearly, even if you look at the formation, right? In this case, you see it just cracked the apex base right here and it went down. In here, it looks like yeah, it just started now. So they kind of have the same trend, but it don't get to have the same price levels. So it might be useful as for the trend, maybe not because they do move the same way, but it might be useful to check for the relative strength or weakness of the dollar against not only the euro and the yen, but all the other uh, currency baskets of the world. Also, bear in mind in 1998, uh, the euro actually came into existence. Before that, the DXY was still saying as components all the different European currency, as the Italian lira, the French franc, or the German mark, and all the rest. So at a point, it was getting a bit old-fashioned, right? They needed to come up with something new, and this is one of the things that you know, although I'm particularly skeptical about the Fed more often than not, in this case, I guess this is a good adjustment, so to speak. Now, let's move into oil because it's very quick. Nothing basically happened, as you can see. We opened up the wick in where? Here? Yeah, here. Monday was down, and then you got bounce. Tuesday, Wednesday, Thursday down, Friday slightly up. So if you check the weekly candle, it's a doji, of course. So we are still hovering around this line of support right here, this famous floor, which is holding price since, well, at this point, 3 years, 4 years maybe. So huge, huge level or huge area. It's not just one single price level, but it's more of an area, right? Um, I still think that for now there are not many fundamental reasons for oil to go up, if not a particular news event or something like it. But as I said, I guess it was last week maybe. If I was particularly bearish before, considering the relevance of this level, I need to cool down my bearishness of oil while we do approach these levels lower. So again, I think I'm back to neutral now, at least for next week. Then we'll see. Okay. Gold. What about gold? Oh, Joe, you're right. Gold, new all-time highs. Right. Um, beautiful. I mean, beautiful price action. It took a while, if you remember, 2 weeks ago, where we were looking at these Fridays low. The market closed the week with these low. The premise was up until this low is protected, we are probably gonna keep on climbing to the upside. The last Friday closed with gold touching into this level. And we said, well, if it keeps on grinding into it, we might see a bit more of upside. Otherwise, it might pull back a bit. But up until the point this low is protected, I still maintain a bullish bias on gold. Guess what? We actually did pull back a little bit. We came back into this base, and then 3 days, Monday, what was that? Well, Monday, Tuesday, Wednesday, all the week was up with a minor retracement here. So yeah, that was good. So yeah, gold, it's living the best of it of its times, it looks like. Um, about gold, there was a huge setup that I played this one, but it was on the hourly time frame with this premise in mind, right? But I was looking at this range, which was established basically in here, all right? So mid-February, and gold was trading in this range. And I mean, how do you come up with this? Well, it's basically when you see an up move, which then fails to have continuation, you try to come up with this range. You try to match levels which are particularly relevant or price sensitive, like this one. It was sensitive in here, and then in here, right? And even in here, and then in here. So you do know it's a good level. And you extend the range out to another level or which shows the same characteristics. Like in this case, could have been this one right here. And then if you want to validate that, you check the equilibrium or the midpoint of the range, and you see if there is a decent level of price sensitivity around that too. And it looks to me like there was here, there was here, there was here, there was here. Price usually tends to get back toward equilibrium. It's just mean reversion. So considering that this was the famous Friday's low we were looking at 2 weeks ago, and given this range, we touched into a level of deviation out of the mean, which was particularly relevant. And then if you check the range low, we came back into the range, gravitated around the EQ, came back confirming that we wanted to hold the range because we didn't crack the range low once again. And then, it was just one of the usual setups I use on very, much lower time frames. But price came down. We swept a bunch of lows and then immediately got back in. He retested the origins of the move, which was responsible for picking up the liquidity at these levels, and it just went up. Now, if you zoom in, now look, with this in mind, right, with the overall movement in mind, with the deviation out, getting back, holding the range, and going up, with that in mind, just try to picture this. Isn't it the same? You got a well-defined range in here, right? And look what happens. Price goes out, quickly gets back in. It stalls a little bit around what you could deem as the midpoint of this range, and then it just goes up. So when you see these formations, these consolidations on whatever time frame you might checking them out, they are good if you see these sort of a under over or over under. You could at least bet on a same amount of excursion to the other side once one of them is deviated out. This is one behavior I do particularly like. And the top, at least for now, we don't know. We will know next week, I guess. For now, the top, it's at the same level of deviation compared to the one which was touched into when we went to the downside. So pretty spectacular behavior, if you ask me. And again, good trade overall. Although, I do also old gold, so that was also fitting my overall bias for gold on a much greater time frame. But it's not bad to be able to make these so-called tactical trades on an asset that you already hold. It could be to just make a quick buck or to increase your allocation. It depends on you. In this case, at this point I just closed more than half of that position. As for the rest, I'm gonna hold it uh, because I'm basically in free roll on gold right now. So why not? Let's move on to Bitcoin. 24/7 market, so it's still moving. Just ignore the red lines. I was just trying to highlight the day Trump was elected and the day of inauguration, since Trump was so particularly pro crypto, and that's what you got. You got the pump at the elections. Inauguration comes in, and you got a drop or a pullback or a retracement, which is not huge. I guess this is probably what 30%, kinda. Yeah, 25, 26%. So if you use closes, of course, if you use absolute highs and lows, it might be a bit more than that, but still. So I was just trying to highlight that these sudden news events are obviously always around the corner, and you should pay attention to them. As for now, I think we are a little bit in a limbo. Okay, so we already touched back into this level, and it looks like we might want to tap in the upper one. So what's going to be? I mean, you might see over the weekend price tapping into it. I don't know why this is white now, but let's make it black. And being rejected. And if it's rejected, you might expect to at least revisit the lows, right? If not, actually, maybe a small bounce around here and then actually lower than that. How much lower? I don't know. Just ignore the squiggly lines here. My hand just leapt on the mouse. Or we could try to attack these resistance now, breaking it, holding it, and try to really put together a bounce and then going to the upside. I don't know, probably to 1 million at this point. I'm open to both of those possibilities at the current moment in time. What I was looking at on a different type of layout was this though. So if you check this one, you see that now we are kind of wrestling with the 200 days moving average. So we are not really above it yet, as on a closing base. But we have lived below it for a while without not much of a continuation. So could we just hover around here for a while, retouching one of these moving averages, which again, for now, they are having a pretty bearish posture. The faster is below the slower. They're both downside angled. So from a moving average standpoint, there is still a lot of work to do. But I was just trying, and again, this is not real analysis. All right, just let's clear the air out before we go on, because otherwise people will keep on thinking, yeah, well, you're just imposing your own views on the market. You're just trying to see what you would like to see instead of what's there. No, I'm just saying, considering that I'm particularly neutral on it at the current moment in time, if I had to come up with a case for a decent bottoming formation, this one would be it for me personally. Okay, so it's just for me, it doesn't have to be for you, and it probably is not going to happen. Okay, let's put it this way, right? But if that was to happen, I would like it a lot if I had to look for an entry point. Okay, so this is the last weekly swing low, which originated all these run up. So you just throw a fib on it, and you look that right now we are hovering around the 50% type of retracement. Another push down would put you around the golden ratio. Okay, not only that, but if you check how indicators and oscillators like the RSI, the stochastics, or the MACD are shaped up right now, if you could have, right, another push to the downside, confirming a 3 drive divergence on these three, or maybe just 2 of them, it doesn't have to be all of them, but 2 out of 3 would be good, right? And then actually bouncing hard from there and starting at that point to reclaim highs instead of being rejected and always making lower highs. At that point, I think the case for a low would be much stronger, especially because you would bounce off of a pretty good level from a structural standpoint. So does it have to happen? Will it happen? Will it happen tomorrow, next week, next month? I don't know. I'm just saying, if I had to check this asset and saying, I wonder what would be my A plus setup in order to be convinced in buying it, that would be it. Then again, maybe it won't happen, but it's another one of those things where you just want to be prepared and you just want to build up a case. Then, if it actually unfolds, fine. If it doesn't, or if the market just negates that, so be it. But still, since you are spending so much time looking at these bullshit charts, sometimes fantasy, I guess it just runs, right? So that would be it for Bitcoin. Now, need to check a few things before transitioning into stocks because there are a few things even on stocks and equities that I do want to discuss, but I just want to make sure I got all my other eventual secondary charts in line and ready for the use before getting in. So just a second and we will be back to stocks. So onto equities, I wanted to make sure I got the right screens to present later on because it's probably going to be a very complex topic. Maybe I hope or I can kind of communicate that at the best of my abilities. But the bottom line is I wanted to check if there is a case for a bottom in the equity market. Now, before we start to call for new highs, I'm just talking about a local bottom. So that doesn't mean that if we kind of bottom out here, if we try to put together a bounce, we are necessarily aiming at new all-time highs, let's say next month. I'm just saying that if you check around, as we were looking at last week, the sentiment at this point, it's particularly fact. So it might be that this is a time where everyone is screaming for the next recession, the next bear market, and they are all massively bearish. And that's usually when the market likes to stick you the middle finger because maybe you're late to the party and you start to sell or to short the market at these levels and you just get hit by a massive quote unquote bear market rally. And again, up until this point, we are looking at a 10% correction in the S&P, a little bit more in the Nasdaq, probably 13%, something like it on the top of my head. So we can't really talk about a bear market. Look, 10% corrections in the S&P, they come around statistically one time every 16 months. So it's like almost once a year or a tiny bit more than that, but it's not unusual, right? So don't panic straight out. So we've seen that Friday had a good close. It closed with what might seem a bit of strength. And again, as many other things in technical analysis and trading, there are always two sides of the story. All right. So we are going to try to start with the positive. So potential reasons for a bounce, and we will transition in what could negate that outlook from, again, a technical standpoint. If you zoom in, or in this case, if you check the ETFs, what we see is that although you might check the charts for a bounce, there is not really the setup for a reversal yet. Doesn't mean that it couldn't happen, right? But if you do remember the Bitcoin chart we were looking at just before, there was all these type of divergences and whatnot. So in this case, you don't actually have them because if you check, let's say this one, see price goes down, the RSI still making lower highs. On the MACD divergence, no, the histogram is always pointing to new lows. On the stochastics, well, the stochastics, it's almost flat, but that's what you get in a trending environment. The stochastics can actually stay oversold or overbought for a long period of time. You might say, yeah, it's at extreme, right? So if we cross the indicator to the upside from these levels, I mean, a bounce at this point might be possible. And that's right the case we are trying to build up, a bounce. Again, want to be particularly clear on that one. Now, if you instead check the upper part of the chart, I just added a new moving average, which is not really new. I mean, it's just a faster one, okay? So this is a 9 exponential moving average. You might ask, why a 9? Well, why not? I've seen many people using the 8. And again, I don't know why. I guess it's just one of those things. Maybe they just back tested it and they've seen that they do like the 8. Um, I've seen other people using a 10 period moving average. And you ask them why, and they say, well, if I'm looking at the short term, if you consider throughout a trading week, there are 5 trading days, I just want to look at something which resemble a very short-term period. So therefore, I'm going to use the 10 moving averages because ideally that gives me the idea of what price has done over the last 10 trading days. So everyone is going to have its own reason, but for me it was the 9. And you want to know my reason? It's just because in the middle, in between 8 and 10. All right. Simple as that. There is nothing else. All right. Because I don't necessarily use moving averages for my own trading. So I don't really care. It's just a visual representation of something. And in this case, it's just a very hard trend to the downside. Okay. So I was thinking that maybe at this point we have been particularly deviated from the core of the moving averages, like the 21, the 55, or even the 200 days moving average. Sorry, the 100 days moving average for what matters. The one in white, it's the 100 days, right? So a bit of mean reversion at that point would be kind of in line with how usually the market moves, right? It's not straight up, it's not straight down, and so on and so forth. Um, if then you maintain the same type of layout, and if you zoom in, let's say on the 4-hour time frame, what you see is that on this time frame, again, 4-hour, how many 4 hours there are in a day, right? On this time frame, you already have that setup similar to what we were looking at on Bitcoin. So you got your usual divergences. You see that on the high, let's say, you see the market making a new high, even on a closing base, right? This high is higher than this one. And you see that the RSI is making new high, the stochastics pointing up, making new high relative to the previous one. The histogram on the MACD is making a new high relative to the previous one. So you get the gist of it, right? So no bearish divergences, okay? So no immediate danger of a drop, right? Standing to the indicator. You see that faster moving average, the 9 period, is in the process of almost closing, well, really crossing above the yellow 21. As for the yellow 21, you've seen that throughout this dump, we basically were rejected every single time around it. And that was downward sloped. Now, if it is upward sloped, or it's trying to get upward sloped while the blue is crossing above it, you might say we are having on these time frames, so very short term, a little bit of a reversal already in place. Be careful because especially if you look at ES, it might turn out to be a false reversal like it was in this case. You see, the blue was almost crossing and price was already leaving above the yellow, and then everything failed. But still, even in that case, it would be a good, I guess, again, a good piece of information, because you might say, well, we got a setup which was suggesting a bit of upside. If that setup is negated at the very useful moment, like in this case, then we might see more downside, and in a good enough amount as it was in this case. So it's still valuable information to look at for me, whether it is confirmed in the original way I'm looking at it or whether it is negated. It's still gonna provide me good enough information for the rest of next week. Okay, if you zoom in even further, let's say you're a day trader, right, and you check the hourly time frame, well, again, you see that basically it's kind of like the same of the 4 hours, but in this case we are way ahead of times. So again, just trying to put together a few thoughts in order to determine why we might see a bounce and how likely it is that that bounce could be sustained. So if you then zoom back out and you look at the higher time frames, what you see is that the first level of resistance at this point might be that same 9 exponential moving average. If we can crack it, the next will be the 200 days, right? We cracked below the 200 days. So now a little bit of a pullback, retesting it, and then we'll see what happens. Look, the reason why I'm saying it might be just a bounce, so don't get overexcited about it. It's because usually if you got moving averages starting to cross, the first test back into them, it might be a rejection. And at that point, the game becomes, okay, we traded back, let's say, just a silly example. We traded back in this region, right? And we got rejected. Can we now establish a higher low, or do we get continuation? That's all about that. Okay, we are just trying to look at, can we bounce? Is the bounce faded? Is the bounce successful? That's it. You're trying to assess price action while it is unfolding itself in real time using reference points as a guidance. So it's always the same type of a step by step. If these and that, if A happens, the odds of B happening increases. If A gets negated, the odds of B are basically negated as well. So, and if those cases are negated, well, the opposite one sees increasing odds to actually unfold itself, right? So I think what might be good to do, especially coming into Monday, Tuesday, and switching layout again, it's looking at the futures market. And now I was checking ES and NQ futures. Now, what we've seen on a Friday, and bear in mind, these are just regular trading hours. So you don't see the Asian session and London session in here. Okay, this is just the periods where the US market is open. Okay, so we've seen in both a gap up. They both open with a gap to the upside. Then what we've seen is that they came back down, testing back around the previous value area high, and they started to rally. So if you see this shift in the value areas, that is usually some sort of a bullish behavior. Now, starting to talk about how and why this thing might fail and you're not gonna be able to see a protracted bounce is the problem with this is that the majority of this pump, it was made basically in the first 2 hours of the session. And as for the rest, we just traded sideways. Why am I saying this? Well, because if you think about the amount of people which might be actually short this market, let's say if you are going to see demand stepping in and all those shorts having to cover, you would expect a much and sharper type of a move to the upside. So that would be one thing which would leave me a bit probably on the skeptical side. Now, again, that doesn't mean that just because we didn't see it exactly as we were expecting it, it's not going to happen. Let's say, comes Monday morning, I'm talking US time frame, and these two markets, they open up here. So with another gap up, right? Let's say around the 19,800 region for NQ, or could be really 5,600 for ES. And they kind of repeat the same pattern. They gap up, they pull back, filling the gap, even partially, and then they pump. Again, at that point, you start to look at this behavior intraday. You get back to the map you were originally establishing on these lower time frames, right? With the context of the higher time frame in mind, and you might want to hunt for longs intra-week up until the point those regions you were identifying as potential resistance at first pass are going to be matched on a higher time frame base. So that would be it for me. Okay. Now, another thing which might be on the more bearish side is that if you now check the sectors, you see that last time we checked them, there were a few which were kind of holding up. Like I do remember, of course, technology was bad, consumer discretionary was bad, and communication, of course, was bad. But I do remember, for instance, healthcare and financials were particularly cool. Now, the problem is that now even financials have been hit. And, healthcare, although it's still maintaining this range, you cannot deny the last week was a bit of a suffering period. Overall, I think it's not all said and done in the sense that if you check uh, this one right here, you see that energy is up, utilities are up, and it looks like what was holding up really well, actually overperforming the rest of the market last week, 2 weeks ago, it's now the one which is suffering the most. Consumer staples and healthcare, right? And even real estate to some degree. While the rest, which was particularly beaten up, technology, it's still down, but it's not down to the same degree it was. Or, another one might be industrial, right? Or materials. So there is still a case to be built up as for another rotation in markets, and we'll see how it plays out. Okay. I guess at the end of it, one good type of assessment might be for both, right? Comes Monday, Tuesday, you might see this market actually coming back down, but it's crucial for me if this scenario would play out, then we don't take out the previous weekly lows. So we might trade back around them, but if I see them cracked, at that point, I would need to massively reassess the odds that I'm putting on this scenario to the upside to play out. Again, the good thing is at that point, you kind of have the doors open to take trades in the opposite direction. for the rest of the week, or at least for those 2 sessions, maybe immediately after the setup failing. I know it's a bit controversial. It looks like, I guess, if you're new to markets, right, it might seem like, well, okay, so basically you're saying that you think this is going to happen, but if it doesn't happen, you're going to do the opposite thing. How does it help, right? You're not giving me information which should supposedly helping me out in taking a decision. Decision one decision. Yeah, well, but that's the point. Since the future is unknown, the best you can do as a trader or as an investor, it's coming up with the potential scenarios you're looking at on the charts and making a plan for scenario A, scenario B. But most importantly, coming up with those triggers, levels, areas, behaviors in price action, which would confirm or deny one scenario or the other. It's not about guessing the future, it is about making a plan for all the potential contingencies you can think of. It's about being prepared, right? It's not about guessing the future and being Nostradamus. It's about being ready for whatever the market could throw at you tomorrow or next week. That's the point of it, right? Now, after the technical part, right? Let's just try to add a bit of a layer of fundamentals reasons because the market could bounce, right? Just for the sake of it. Okay. So I was checking, and I guess it's public domain. It's not really something secret, but I was checking the New York Exchange advanced decline indicator. It's a very simple indicator. It's not rocket science. It basically takes the stocks which are going up, and it just subtracts the stocks which are going down. If you get the gist of it, it's not really, something which is hard to get. You take the amount of total stocks you see, right, and you make some sort of an algebraic sum or addition, and it's just another way to grasp the breadth of the market. So basically, the participation. It might be useful in the sense that when it gives you a divergence, it can give you a clue that the market structure you're looking at it's particularly weak. So for now, when we look at it, we're seeing that it started to go sideways while the market were still climbing to the upside, and now the market actually catched up with it and it dumped 10%, as we were saying. Now, it did the same kind of like in the past when Russia invaded Ukraine, for instance. It did the same throughout the COVID pandemic. There was another period in the past, I guess, still during a Trump presidency in 2018-19, and it was about the taper tantrum back then. So it can actually signal a bit of weakness or potential weakness coming into the market. Right now, this indicator, it's not particularly one way or the other. I think it's all about saying if the market can recover and if this indicator will actually have a bit of a bounce itself. Just notice that historically, when you see this indicator going down or sideways while the market goes up, that signal weakness. But many different bottoms have been formed while the market was going down and even the indicator was going down. Why? Well, because the market was going down and the breadth was increasing. So when the market actually can put together a bottom, now you have the ability for all the stocks which were massively overvalued to have a bit more of an organic rally together with the others which were not participating in the rally before. So it's just like the market, it's resetting itself a little bit. Okay, that would be one. Another reason might be if you check the 5-day average of the total put option volumes, you see that we've just touched into levels which we rarely seen in the last 4-5 years. Now, why it is important? Well, it might be just another measure of sentiment, right? Because why would you buy a put option? A put option gives you exposure to the downside. So you're basically just trying to play the market to the downside. Or you're holding many different assets of that particular market and you just want protection. The point about protection and insurance is that more often than not, people comes to buy protection not when they need that, or at least it's kind of no, it's actually a bit different. The saying is you should buy protection when you don't need it, because when you actually need it, it's already too late. So again, uh, are people kind of throwing in the towel and starting to buy puts because they think the market is going even lower than that? And if everyone is thinking the market is getting lower, it means the sentiment is particularly bearish. And we do know that when everyone are on the same side of the boat, something different tends to happen. And then you got you know, the dynamic, the mechanical dynamics at play. If everyone are actually buying puts, there is a huge interest from a speculative standpoint to actually drive the market higher. Therefore, those puts might expire worthless. And even if you don't think people would actually do it, that happens. If you check indices intraday, and that's not really my bread and butter, but I'm looking at guys which are using indicators to highlight, um, you know, 0 day expiration option levels, or monthly options levels where the massive concentration of strikes have been purchased, and those levels usually are very sensitive. So it's not unusual to see the market being driven around those prices. And sometimes you get the rejection, sometimes they are just completely smashed, and you got those dynamics which involves the gamma being positive or negative. It's really fascinating to look at. Although I'm not really an expert on the topic, you shouldn't discard that to happen, right? These things, I've seen them happening. So they do play a role one way or the other. So just don't discard the fact that beside the sentiment indication you might get from this indicator, there is also the mechanical dynamics behind it, right? As for the volatility, which we might check and here, so we've seen that volatility, it's currently ticking down a notch. And again, that could be another indicator of a potential bounce. Um, every time we have seen volatility spike, it's usually when the market kind of get nervous, and oftentimes it is associated with drops in the market. But if volatility gets back under control, what you might say is, well, okay, so we are ready to resuming the upside. Again, in this case, we are still looking at it in the context of a bounce, but who knows, right? That would be another one. And it looks like, again, we were looking at last week the price signature, the price behavior that the S&P is having right now compared to the previous Trump term. And we've seen how the price action of now, it kind of resembles the price action of those times. It looks like even the volatility behavior is reflecting what was going on back during actually the first Trump terms. So again, another thing which might suggest a bit of a cool down in volatility, and therefore uh, potentially a good opportunity for stocks to bounce or to go a bit higher than these, right? Another thing might be currently we are looking at retail purchases, which are actually seeing a good amount of volumes. So are retailers buying the dip once again? And most importantly, is it cool or is it not? Because usually retail investors they are exit liquidity. So you could read these data, I guess, from both perspectives, but it's important to notice that recently a lot of dips have actually been bought by the retailers, and you should never discard in the nowadays market dynamics the power that a passive investment actually has. So passive funds that they just, it's the usual dynamic. $1 in, the dollar is gonna buy the different stocks depending on how they are weighted in the index. The giant mindless robot, as Michael Green likes to refer to it. Other than that, if you check, I actually added to the charts right here. Where is it? There you go. If you check the DAX, so the German benchmark, right? We are noticing a massive divergence when it comes down to the returns from comparing the DAX to the S&P. All right. Now this is curious to some degree. I know that there was this narrative about everyone now betting on Europe because of rearming Europe, massive public spending and whatnot. While instead, the US are actually pulling back from all these government spending. So you do expect returns to be better in Europe rather than in the US. And also the problem with valuations being massively extended to the upside in the US, while at the same time they are not so much in Europe. I think it's maybe not all the story because I was checking in a report and it looks like, on this dump for the S&P and this pump as for Europe, it looks like the flows um, were a bit, you know, contradictive because we've seen a lot of flows getting into uh, American assets and a lot of flows actually getting out of Europe. So at that point, the logic will be, well, basically people are buying the dip in US assets and they're using this pump in the European assets to get out. Will it be? Could this be? I I honestly don't know. I was just thinking it was an interesting point to highlight. So again, another case, or at least another piece of the puzzle to sustain a potential bounce scenario is that if you check at the Mag 7 and if you check the infamous price to earning ratio, well, now those P actually came a lot lower compared to where they were a few weeks back. So although, and again, I know it sounds crazy to say, but it might be that when you look at these stocks, in terms on what do you call it? I just fucking forgot the term now. It was trailing earnings base, I guess it was the term. But if you check these stocks using that metric now, something like Nvidia could actually be cheap. Because I mean, at the end of it, yeah, earnings might have been revised lower a little bit, and even estimate for future earnings might be revised a bit lower, but still, you can't negate the fact that Nvidia is still making a lot of money. So probably the last earning report, it wasn't welcomed by the market with so widely open arms. But if then the stock takes a 30% haircut, well, now it might be a good value. I know, again, it sounds crazy because not more than 2 months ago, we were already talking about the AI bubble burst, but are we there yet? So again, if you start to check these fundamentals and you add them on top of what we have discussed so far, that would add to the case of a bounce. All right. Uh, Plus, remember that just because we got a 10% correction, well, that doesn't mean that we're going to see a bear market. And there are actually studies in the past which can give you a bit of insight in what historically happened after a 10% correction. So more often than not, and with a good amount of, probabilities, a 10% correction, it's not necessarily the start of a bear market unless you got further catalysts on top of it. Okay. So again, lastly, I guess we might check the usual seasonality. And we hinted at this last week, right? We said, well, the best case scenario might be to hold on till the end of March and, trying to not lose a lot. As for, farther downside, and probably if we can get till the end of March alive, we might see a bit of a relief in equities. So again, the seasonality looks to be confirming that pattern over the last uh, two decades. Maybe I will have to check back again, but I think it was 20 years as for these statistics. So if we can get out of this period of the year and getting back into, April, May, we might see a bit of upside in stocks. Again, at least from a seasonality standpoint. So it doesn't mean that you're gonna see it no matter what. And remember that a bit of upside could just mean we get back around the highs, maybe slightly above it, but overall, for the rest of the coming months, we don't actually move a lot. We kind of stay on a macro range bound environment. So always be careful and always remember that the name of the game that we were anticipating for 2025 was volatility and subdued returns because of 2 consecutive years of 20% plus returns in the S&P on a annual base. So not saying it couldn't happen again 3 years in a row. I'm just saying, you need to really weigh your odds out in this case and be prepared for everything the market could try to to put in front of you. All right. So I wanted to talk another thing, but I think I'll just skip it. Maybe next time because I don't want to breach again the 1 hour mark. Although I think I'm already there, probably we are around 1 hour and 5-10 minutes. So I'm just gonna leave it at that. We'll see what's gonna happen next week. We'll see if this bounce can actually unfold itself in the equity market. We'll see if gold will keep on climbing higher. We'll see if Bitcoin, right, as a risk on asset, could actually put together a bounce as well. We'll see about oil holding the macro support. And we'll see if the DXY can actually, again, having a little bit of a bounce. Which, by the way, closing note, I think the chances of a bounce, generalized bounce in risk on assets denominated in dollars might be actually higher if you can have the DXY bouncing at the same time, right? So we'll see. We'll just observe and verify and get back to it next week. As for now, have a fantastic rest of your weekend. Have a good Sunday. Be ready for Monday. And as usual, be nice and be cool. Neil's out.
Yeah.
Money never sleeps, pal.
Just made 800,000 Hong Kong gold. It's been wired to you.
Play with it. You done good, but you gotta keep doing good. I showed you how the game works. Now school's out.
Mr. Gecko, I'm there for you 110%.
No. You don't understand. I want to be surprised.
Astonish me, pal. New info. I don't care where or how you get it. Just get it.